Welcome to another episode of Lendgo's Mortgage Mastery Podcast, where we delve into property investment and financing. Today, we're discussing a really important aspect of property investment that first-time investors often overlook when comparing property loan rates. Whether you're a seasoned investor or venturing into real estate for the first time, understanding the importance of comparing loan rates can significantly impact your investment journey. Today, you're going to hear key benefits, including saving on additional costs, maximizing investment returns through lower interest payments, and evaluating monthly payment options for better financial management. Understanding the terms and conditions of loans is really important for long-term planning, and comparing lenders helps make sure you have the most favorable terms for your investment goals. So let's get started. Why compare loan rates before investing in properties? Before we discuss the reason for comparing loan rates, let's address why it's essential. Many first-time investors are eager to enter the market without fully understanding the implication of their financing decisions. However, comparing loan rates can prevent costly mistakes. Here are 7 important things to consider before investing in properties. Number 1, saving additional costs. Regarding property investment, every dollar saved can significantly impact your overall profitability. One of the most effective ways to save on costs is by comparing loan rates from different lenders. Here's why saving additional costs through rate comparison is crucial. Identifying lower rates. Many lenders attract borrowers with enticing offers, but these often come with higher interest rates hidden in the fine print. By comparing loan rates from various lenders, investors can identify those offering lower rates. Even a small difference in interest rate can translate into substantial savings over the life of a loan. Cost-affecting financial options. Different lenders have different lending criteria, offering varying interest rates, fees, and terms. Without comparing rates, investors risk missing out on more cost-effective financing options. By shopping around, comparing rates, and minimizing borrowing costs, investors can secure the most favorable terms. Long-term savings. While the immediate focus may be on securing financing for a property purchase, it's essential to consider the long-term implications of loan rates. Even a slightly lower interest rate can result in significant savings over the life of a loan. Investors can save thousands of dollars in investment payments over time by comparing rates and choosing the most competitive option. Enhancing investment portfolio. Saving on borrowing costs through rate comparison allows investors to allocate more funds to diversify their investment portfolio. Instead of spending more on investment payments, investors can use these savings to invest in additional properties, stocks, or other income-generating assets. This diversification could potentially increase overall investment returns. Competitive advantage. Every advantage counts in a competitive real estate market. Investors gain a competitive edge over other buyers by securing financing at lower rates. Lower borrowing costs mean investors can offer more competitive purchasing prices or negotiate better terms with sellers. This can increase the likelihood of securing desirable properties and achieving higher returns on investment. So it's important to see that saving additional costs through loan rate comparisons is important for maximizing profitability and property management. When you identify lower rates, investors can secure more cost-effective financing options. This includes borrowing costs, it improves cash flow, it enhances their investment portfolio, and you can gain a competitive advantage in the market. With so much at stake, comparing loan rates is such an important part of investment strategy, and it will lead to significant long-term savings and success in property management. So the first thing to consider is saving additional cost. The second thing to consider is maximized investment returns. Maximizing investment returns is the fundamental goal for any property investor, and comparing loan rates is a strategic way to achieve this objective. Lower interest payments translate directly into higher net profits, giving investors more capital to reinvest or expand their portfolios. Here's how comparing loan rates can lead to maximized investment returns. Reduced borrowing costs. Lower interest rates result in reduced borrowing costs over the life of a loan. By securing financing with loan rates, investors can minimize the amount of interest they pay and increase their net profits on the investment property. This additional capital can be reinvested into additional properties or used to fund property improvements, ultimately leading to higher overall returns. Increased cash flow. Lower interest payments improve cash flow as investors have lower monthly mortgage payments. This increased cash flow can cover operating expenses such as property maintenance and management fees, or invest in income-generating assets. Investors can enhance their overall financial stability and profitability by maximizing cash flow through lower borrowing costs. Faster debt repayment. With lower interest rates, investors can pay off their loans more quickly, and by allocating more funds towards loan principal payments, investors can reduce the total amount of interest paid over the life of the loan and shorten the loan term. This accelerated debt repayment strategy can increase investment returns in the long run. Opportunities for portfolio expansion. By minimizing borrowing costs through lower interest rates, investors free up more capital for portfolio expansion, whether it's acquiring additional investment properties or diversifying into other asset classes such as stocks or bonds. Having access to more capital enables investors to capitalize on new opportunities and maximize their overall investment returns. To sum this up, comparing loan rates is an important step in maximizing property and investment returns. Lower interest payments result in reduced borrowing costs, increased cash flow, faster debt repayment, and opportunities for portfolio expansion, all of which contribute to higher net profits and greater long-term wealth. By carefully evaluating and selecting the most favorable financing options, investors can optimize their returns and achieve their financial goals in property investment. So the first thing to consider is saving additional costs. The second thing to consider is maximized investment returns. And the third thing to consider is the comparison of monthly payments. Managing monthly payments effectively is important for maintaining financial stability and achieving long-term success when it comes to property investment. Comparing loan rates helps investors secure favorable interest rates and allows them to evaluate and choose monthly payment options that suit their financial situation. Here's how comparing loan rates facilitates the comparison of monthly payments. Assessing repayment flexibility. Different lenders offer varying degrees of flexibility in repayment terms. Some may allow borrowers to adjust the frequency of timing of their monthly payment, while others may offer options for interest-only payments or what's called balloon payments. Now, by comparing loan rates, investors can assess each lender's repayment flexibility and choose the option that best fits their cash flow needs, and financial preferences. Evaluating affordability. Monthly payment options directly impact an investor's cash flow and budgeting efforts. By comparing loan rates, investors can evaluate the affordability of different monthly payment options based on their current income and expenses. This allows investors to choose loan terms that strike the right balance between affordability and long-term financing sustainability. Understanding payment structures. Loan rates are not the only factor influencing monthly payments. Loan structures also play a significant role. For example, some loans may have fixed monthly payments throughout the loan term, while others may have variable payments that fluctuate over time. By comparing loan rates, investors can understand the payment structure offered by different lenders and choose the option that best aligns with their financial goals and risk tolerance. Considering loan terms. When comparing loan rates, investors should consider the overall loan terms in addition to monthly payment amounts. This includes loan duration repayment penalties and amortization schedules. By evaluating these factors alongside the interest rates offered by different lenders, investors can decide which loan option is the most suitable for their investment strategies. Planning for future expenses. Comparing monthly payment options allows investors to plan for future expenses. By choosing a loan with manageable monthly payments, investors can free up cash flow to cover unexpected costs, fund property improvements, or reinvest in additional properties. This flexibility is really important for navigating the ups and downs of the real estate market and ensuring long-term financial success. Ultimately, this approach helps investors manage their finances effectively and maximize their chances of success in the competitive world of real estate investing. The fourth thing to consider is the evaluation of terms and conditions. When evaluating terms and conditions, investors should consider loan duration, prepayment penalties, repayment schedules, and additional fees or charges. By comparing lenders, investors can identify loans with terms that align with their investment goals and financial preferences. For example, investors may prioritize loans with flexible repayment options or minimal fees to maximize their financial flexibility and minimize costs over the loan term. Also, comparing terms and conditions allows investors to avoid pitfalls and choose loans that offer the greatest benefits and protections for their investment portfolio. Understanding and comparing terms and conditions is such an important step in the loan selection process. This enables investors to make informed decisions and optimize their long-term financial outcomes. The fifth thing to consider is the different financing solutions. When comparing financing solutions, investors can consider factors such as the loan terms, interest rates, repayment schedules, and even eligibility criteria. For example, some investors may prefer traditional mortgages with fixed interest rates and long repayment terms. In contrast, others may opt for adjustable rate mortgages or interest-only loans to minimize initial costs or take advantage of potential interest rate fluctuations. Investors may explore alternative financing options such as private lending, crowdfunding, or seller financing to diversify their funding sources and access unique opportunities in the marketplace. By comparing loan rates and exploring different financing solutions, investors can make informed decisions that align with their investment objectives and financial circumstances. The sixth thing to consider is risk analysis and management. Comparing loan rates allows investors to assess the impact of interest rate changes on their investment returns and cash flow. Investors can develop strategies to mitigate potential risk and safeguard their financial future by considering various scenarios and conducting risk analysis. Comparing loan rates enables investors to identify lenders that offer favorable terms, such as flexible repayment options or even loan modification programs. This can help manage risk during challenging economic conditions or even unexpected events. Conducting risk analysis and management through comparing loan rates is really important for investors to make informed decisions and also to make sure that they have a stable and resilient investment portfolio in the long term. And the seventh and last thing to consider is market trends. You need to stay informed about market trends. This is important for investors to make informed decisions and to adapt to changing market conditions. By comparing loan rates from different lenders, investors can gauge how lenders respond to shifts in interest rates, economic indicators, and regulatory changes. This information allows investors to anticipate market trends and adjust their investment strategies accordingly. Comparing loan rates helps investors identify emerging trends in lending practices, such as changes in underwriting criteria or the introduction of new loan products. This insight enables investors to stay ahead of the curve and capitalize on opportunities that arise in the market. Comparing loan rates is such an important tool for investors to stay informed, make smarter investment decisions, and achieve long-term success in their real estate ventures. So what is our takeaway from these 7 things to consider? Comparing investment property loan rates is essential for maximizing your returns and minimizing risks. Take time to review each factor before you choose your lender, and don't hesitate to seek professional guidance if needed. That's it for today's episode, brought to you by Lendgo. Thanks for listening, and be sure to join us next week for more tips and strategies where we will help you succeed in real estate investing. Until then, happy investing.